how to trade crypto with leverage professionally and seriously. We're going to be using Apex for this, which is Bybit's decentralized exchange. So I'll show you how to connect your wallet, get funds in here and start trading with leverage if you want to. Timestamps for everything down in the description. So what I'm going to do is connect my wallet firstly. I'll show you this on the browser. You can also do it if you have a phone wallet as well. So connect wallet. I'm going to connect my Rabby. I'm just going to click MetaMask because I've got the Rabby extension. So it's going to go through. I'm going to press connect. And then connect my wallet, and I need to set up an account. So I'm going to send the request to get a signature. This proves that I can sign transactions and that I can sign into the account, because this is a decentralized exchange, which means we don't sign up for anything. We just have to prove that we own the wallet that's connecting to it. So I'm going to sign this, press confirm, and then it says create an account. So we're going to have to press create on the right-hand side, create an account, agree to the terms. Then we have to initiate the signature, which again is just signing a transaction here to prove that we have the wallet. So we're going to do that, press sign. This is all free, by the way. It doesn't cost a blockchain transaction or anything. And there you go, the account is complete. If you don't have an Apex account yet, I will leave the link below to a 5% lifetime trading fee discount. So what that means is each wallet that you have an account with, if you use that link, that wallet specifically gets a 5% lifetime trading fee discount. Of course, if you use a different wallet and it didn't go through that link, then that won't. But any wallets that are assigned via that link will get lifetime 5% trading fee discount. So you can find that link. I'll leave it down below in the description. The reason we can trade on Apex just like a centralized exchange is because what we're doing is sending some USDT into the exchange. We're trading it, and whatever the balance is left after we've traded, we can withdraw that back to our wallet. So we're not going ahead with a blockchain transaction every single time that we trade. So it doesn't matter which blockchain that you're using. All you have to do is send some USDT into the exchange using one of the supported blockchains. You can see them here: Arbitrum, BNB, Ethereum, Mantle, Base Chain, probably more in the future. It doesn't matter which one you use, you're just sending the USDT into the exchange. I'm going to use BNB chain because if you can see my wallet, you'll notice that I have $1.28 of BNB coin on the BNB chain. So I can use that to pay for transaction fees on the BNB chain, and I can send in some USDT using that into the exchange. So what I'm going to do is go and send some USDT into my wallet on the BNB chain, and from there we can send that and deposit it into Apex. Back in my centralized exchange, I've bought some USDT. I'm going to withdraw this from the centralized exchange into my wallet, and I'm going to use the BNB chain right here because that's where I'm going to send it from into Apex. I'm going to withdraw an amount of the USDT into my wallet. So press confirm here. That sends that USDT into my wallet that I own, and then we can deposit that into Apex. Now that money is deposited into my wallet, you can see that right here. I've got 100 USDT on the BNB chain. So what I can now go ahead and do is deposit this in. So down here above my head, we're going to press deposit, BNB chain, USDT. You can see I've got $100 in here. So we can deposit this in. So firstly, what we're going to have to do is enable USDT. So we'll go through and do that. This is just enabling the asset. You have to do this in your wallet. So we're going to press sign and confirm that. Go back out. Once that's confirmed, we can then send that into the exchange. There's a lot of steps, I know, but this is decentralized trading, right? It's just a bit of a mess right now. So we've got BNB chain, USDT, max, confirm deposit, sign that transaction, pay the transaction fee. So if you don't have any of the layer 1 coin in your wallet on the chain that you're using, so BNB chain is BNB coin, most Ethereum layer 2 solutions use ETH as gas, then you'll need that in your wallet as well. So like I said, yes, a lot of steps to go through to actually use decentralized exchanges. Once you've deposited that money, it's going to go into your spot account. And if you want to trade on here using leverage, we need to put it into our futures account. So go to dashboard, go to profile, and then overview. You can see that here we've got the $100 in our spot. So we're going to transfer that from our spot into our perp account. USDT, max, confirm transfer. That's an internal transfer, so you won't be paying any blockchain fees for that. And as you can see, that's now in our perp account. So we can go to trade now, and then the contract account, and we've got that $100 that we can use. You can see that right here above my head. Now we can use that to actually margin positions. Let's go through the trading screen and explain exactly what we're doing here as well. So we have the asset that we're trading, and we are margining our position with USDT. What does that mean? We're trading futures here, which are a derivatives contract. We're not trading the underlying assets, we're trading a contract of them. And so the price that we're trading here is simply what we're trading. We're trading this price going up and down. So if we take a long position, we're wanting the price to go up. We can also take a short position and we benefit from the price going down. The way we benefit is by closing the position and taking the profit, or if we have a loss, we take that loss as well. We are not buying and holding the asset. This is not for investing. This is for your day trading account, 10% of your portfolio here. And the way that we do this is that we use this margin here to margin our positions and essentially pay for losses. That's what it's here for. This is our margin. So if we have $100 here, we can trade actually with more than that. We can trade with $500 and even $1,000 if we're using 10x leverage. What does that mean? Well, if you're using leverage, and let's say you're using 10x leverage, so the position that we have, the size of the position is $1,000. Well, if the position moves down 10% against us, 10% of 1,000 is $100, our margin will be wiped out. So that leverage we can use to make a larger position, but then the risk increases as well because a smaller percentage move means that we get wiped out far more quickly. And of course, if it goes up 10%, right, then you make $100, you've actually doubled your amount that you had in margin. Now, you don't have to use leverage to increase risk. What you can do is actually reduce the amount of money that you need to put in positions. That's the more professional way to do things. You can take a very small amount of leverage and have extra money left over for different types of positions. That's a more professional way. Obviously, the kind of beginner's way is just to leverage up and use loads of leverage and get wrecked, but we're not going to do that in this video. So that's how we use the leverage and the margin here. We are trading the price and we're not buying the asset. Up here is important as well, which is the funding rate. The funding rate is something that keeps the futures price in line more or less with the spot price. Because remember, we are not trading Bitcoin here. What we're trading is this price. And so this price has to remain very close to the actual price of Bitcoin. Otherwise, the contract becomes completely useless. So the way that the exchange or every exchange tries to do this is by essentially a fee to try and push the market one way or the other. So essentially what it means is that if this price is being bought and pushed up and it gets higher than the underlying Bitcoin price, that's obviously not good because it's now too expensive compared to the price of Bitcoin. What the exchange will do is put a positive funding rate on that for people going long, pushing the price up. That's a fee that they have to pay for going long, pushing the price up, and they pay that to people on the other side who are taking short positions. So if you take a short position there with positive funding, you are getting paid that fee from people that are taking a long position. And you're getting paid to take that short position to try and push the market down into what the actual price should be. Now, the flip side of that, if a lot of sellers are coming in and pushing the price down, and this price is lower than the spot price, then this funding rate will actually go negative, which means that sellers or short sellers will be paying that fee to buyers, because buyers, they want to incentive buyers to come and push the price up and keep it in line again. So this can change, and it changes every hour, as you can see here. Every hour it could be positive, it could be negative, depending on what the futures price is compared to the spot price. Overall, you don't know, right? If it's positive or negative, you don't really know. Overall, you just have to keep it in mind because during really big bull markets, this is going to be positive and it can get to an annualized rate of maybe 10, 15, even 20% annualized interest that you're paying or fees that you're paying. Now, if you've got a position open for a day or a week or a month, it's not really a big deal, to be honest, but it's just something to keep in mind because you can actually receive this funding or you have to pay it out. So just keep that in mind when you're trading, and also the amount of margin that you have in your positions, because if you've calculated that your margin is going to be very, very tight, this funding can obviously eat away at your positions, especially if you've got them open for a longer time. Again, for the most part, it's not going to make a massive difference, but something to keep in mind. Now let's go ahead and use some leverage in a trading position. So this is a trading position, which means we have an entry and we have a stop loss. We must have both of those things. If you don't have an entry and a stop loss, then you have no idea how much leverage that you can take in your position because you don't know how much is at risk. Right? If you just have an entry with an amount of leverage, where's your liquidation? How much risk are you taking? Right? You don't know those things. So you must have both of those things first. Once you have those things, it's easy to work out how much leverage you can take. So from here, what we're going to do is work out a trading strategy, and then we can work out what our entry and our stop loss would be and how much leverage we can take. So we're going to go over to our strategy. The first chart I'm going to show you is a screenshot of the Bitcoin price on a 200-week moving average. As you can see here, this is an investor's chart. So if you just bought Bitcoin every single week, right, and you did that over time, that's what your portfolio would look like. Okay, so that's why we invest. That's very important. Now let's go over to trading. This is more of a trading chart, and it shows the price, the daily price of BTC. And these right here are drawdowns in bull markets. So if you think we're in a bull market, and they're very clear, the bull markets are very clear, right? It's where you're actually just trending up. We have these drawdowns. Now what you can see is these drawdowns are from anywhere from about 20% to 50%. 50% are the very big drawdowns, and they do occur, but the usual drawdowns are around 20-25%, maybe to 30%. So let's play the odds with trading. Trading is not a 9-to-5 job. You can't come in every day and press buttons. There are opportunities that present themselves fairly irregularly. You have to identify them, and when they occur, then you can actually go ahead and place your trade. And you don't have to spend too much time doing it. So we know that during bull markets, Bitcoin draws down 20 to 30% is kind of a fairly regular occurrence. Now, we can play the odds, right? So if you're taking a long position, which you will be doing in Apex because you have USDT, and that's margining your position. So you're obviously going long the asset, and we're in a bull market. You can use USDT to short as well, for sure, if you want to do that in a bear market. Let's stick to long for now. So 20 to 30% drawdowns are opportunities where in bull markets, you draw down but then bounce from those. And it can go to 50%. So what we know is, what we're searching for is drawdowns of 20 to 30% to take a position and to make sure that we have a stop loss around, let's say 40 or 50% drawdown. It could occur, but maybe we don't want that to happen. And if you want a tighter stop loss, you could say, I'm going to get in at 20-25% drawdowns. And if we get the 30-35% drawdown, we could cut our position there if we don't want to, to actually get further losses, right? So it's up to you, but these are the odds that we're playing. In around 20-30% drawdown and a stop loss somewhere around 40-50% drawdown. It's up to you, right? That's the trade that we're in bull markets. Playing the odds on those trades, and we get a lot of these opportunities throughout bull markets. Now we'll go to the Bitcoin chart, and from here we can actually plot these on the chart. These red boxes, I'm on TradingView, by the way, because the Apex charts aren't very good. So go to TradingView, it's free. You can do this for free as well. Brilliant. I'll link them below. These red boxes are about 20% or more drawdowns from the range high, right? So this one here, so we've got 3, 4, 5. Basically 5 opportunities within this bull market to take some positions. If you are thinking that a 20+% drawdown is somewhere where you'd actually want to take a position, knowing that it might go lower, and we can take those. So these are the irregular opportunities that we get. This one right here, as you can see, was a fairly big drawdown. This wick down here was about 33%, but the candles are around 25% drawdowns. So we can get in around these drawdowns, 25%, and then from that level, another 20 to 25% drawdown is something that could happen. They happen a couple of times in a bull market, so that would be a stop loss level. Or if you want to be a little tighter, you can say, I'm going to trade this 20 to 30% drawdown, right? But I'm going to move my stop loss up to something like a 40% drawdown, something like that from the literal range high, 34%, right? So it's up to you where you place your stop loss. Right, you can look at previous support and resistance levels if you want. Right, so there's one here. Right, you can see that level. That was a rejection level, which ties in with this consolidation as well a little bit. Right, so that would be a level where it may get to, maybe a bit above that, something like that. We actually broke out from this level, so something like that would be a decent stop loss. Right, now it may fall down there, of course, but we're just playing the odds. We know we get these 20 to 30% drawdowns, and we do most of the time bounce from those, but it's possible that we go lower. So in any case, however you play it, if you want a tighter stop loss or one further away, it's important that we get the entry level and the stop loss, and then we can work out our leverage. I'm going to make it easy and say that we're going to get in at 60 and that we're going to stop loss at 50. So that's going to give us our leverage amount that we can take. So you can go to a Bitcoin position size calculator. I'll leave this one link below. Bitcoin USD, we're trading, we're depositing USD. We're going to open the position at 60K, and our stop loss is 50K, like this. Whatever your account balance is, and how much of your account do you want to risk? So most people will say about 3% of your trading portfolio, not your entire portfolio, but your trading portfolio, how much you've got in that. Do you want to risk 3% in each and every trade? You can calculate, and down at the bottom, we can see that we can trade this amount of BTC, which is 0.03 Bitcoin. Our money at risk is 300 because it's 3% of our account balance. Obviously, change this around in any way that you want. You can move it around. Doesn't matter how much you have and how much you want to risk. Do you want to risk 10% of your portfolio each time, right? That is up to you. So what do most traders do? Most traders say about 1 to 3% of your trading portfolio you might want to risk. Maybe a little bit more if you are just having a trading portfolio with a bit more risk. So let's go 5%. Now, you're just playing odds here again, right? So how much of your portfolio do you want to risk? How much do you think the odds are that if you get in at 25% to 30% drawdown, what are the odds of actually going under your stop loss, right? Fairly low, but we are going to get 40, 50% drawdowns potentially. And obviously we're going to get stopped out on those if we've got a tight stop loss. So you have to work out yourself, if you've got, let's say 4 to 8 of these opportunities in a bull market and you want to trade those drawdowns, what are the odds here for you and how much risk are you taking around that, right? That's down to the individual. How much are the odds do you think that if you get in at 25 to 30% drawdown that we're going to get a 50% drawdown? Where is your stop loss in that? How much pain can you take? How much of the portfolio do you want to risk on each of those trades? That's up to you. We'll have a $1,000 balance, 5% risk. We can trade 0.005 BTC on a $1,000 balance. Or if you want to have any other balance, it's going to work out. That is the trade size. That is how much we can risk. So then we can go ahead and actually take the position. Now we can use those ratios to go and enter the trade into our trading platform. So whatever the ratios tell you and the calculations tell you, so if you can trade 0.1 BTC, you can do that. 0.05 BTC, you can put that in here. That's the position that you trade with the market. That's the size of your position in the market. Right, so you can trade that in any size that is appropriate for you. You can also change this if you want to look at it in USD terms. So you want a $500 position, you can do that pretty easily, right? So it's up to you which one you use. Now from here, we need to choose the leverage. You can see this in the right-hand corner. The leverage, all this does is changes the amount of money that we put down into the position. So let's choose 1x leverage, which is no leverage. Right, so if you want a $500 position, you need to put $500 in. You can see that's a $500 position, and by long, you can see down here, this is the amount of USDT that is required to open this position for us. Right, so with 1x leverage, you're essentially funding the entire thing with money that you tie up in that position. That is paying for any potential losses. We have no leverage, which means that we're funding the entire position. Now, as you move the leverage up, all you're doing is changing the amount of money that you put in this position. So with the exact same position size, $500, look at this, buy long is now $15. What we're doing is putting less money into the position to fund the size of that trade. That's the leverage. It's the leverage based on the amount of money that you type in the position, right? So if you have $100 in the position and the position is $1,000, you're using 10x leverage because it's 10 times the capital that you actually have put down in the position. The only thing that matters here is what your stop loss level is and what your liquidation price is, right? So let's say we're getting in at 60 and our stop loss is 50. That's where we take our loss ourselves. We do not want the liquidation price to be within our own stop loss. If our stop loss is 50K and we're using so much leverage that our liquidation price is 55, then our stop loss is irrelevant because we're going to get stopped out before our own stop loss. And that is absolutely unacceptable because we are playing the odds. We know what the odds are. We have an entry, we have a stop loss. We know that the odds are that it will trade within that. And so that's what we have. And the liquidation price must be away from your stop loss. So we can work this out as well. There's no calculator on Apex, unfortunately. So I'm going over to Bybit and I'm using the liquidation price calculator. If you do have a Bybit account, go to derivatives and go to inverse perpetuals and then any of these assets. I've just chosen Bitcoin here. On the right-hand side, click this calculator and it brings up the liquidation price calculator. We're going to go long and our entry price is 60,000. And 10x leverage, let's say we've got $1,000 here. With 10x leverage, our liquidation price, if we're entering at 60, is 54,000. That's within our stop loss. Our stop loss is 50,000. So we can't trade with 10x leverage. Let's try 5x leverage. It's pretty close. So let's take 3x leverage. Okay, now we're good. We could probably take 4x leverage. Our stop loss is 50. This leverage is going to liquidate us at 40. That means that if we take our position at 60 and it just goes straight down, the amount of money that we're tying into that position, it's going to get liquidated if it hits 48,000. We're going to stop ourselves out and actually sell for a loss above that, right? So that's how to use leverage intelligently, is to tie less money up in the position. So we don't want to tie all of our money up in that position because if we're in a bull market, maybe we want the dollars actually invested in Bitcoin or we want them put into a DeFi protocol, right? Like are they earning some interest because other people are taking leverage and paying interest there? We can use that money in a more productive way, right? We can put it earning interest or have it in BTC or other assets or anything else that we want. We don't have to tie up all this money in these positions. That is how you can take leverage without increasing any of your risk, because you know that position size already. In at 60, stop loss at 50, we can use Forex leverage without increasing risk at all. Now, if you want to increase risk, then you're just taking extra leverage on top of your position, right? So if you take a 10x trade, that's fine. You can do that. But what you're doing is moving up your liquidation price to now 55,000. And the odds are, right, if you're trading at a 25% drawdown, the odds are that, you know, you're going to get those times where it goes to 30, 35%, which means that it's pretty close to the liquidation price, which means that you're liquidated, which means you lost that trade, which, why would you want to do that? So we have to use leverage intelligently. We have to know the odds of where prices trade and the volatility of the asset. Bitcoin is 50 volt asset, 50% move, right? So this is important stuff if you want to actually use leverage intelligently and basically keep your positions and keep your portfolio, because the number one thing is in positions don't get wrecked. Now you know how to use that leverage intelligently and kind of move around the leverage as to where you think the price may get to in your stop loss positions and your entry positions. I'll show you how to open the trade on Apex then and what it looks like. So we're going to buy long with an amount, and I've got an amount of leverage here. So let's just turn this right down to like this. And we can buy long with an amount. You can see I'm putting $30 into the trade. So confirm that. And that order is open. So it's just like a centralized exchange, right? There's no signing with your wallet or anything like that. We have a long position here. You can see the quantity and the value and the unrealized profit or loss, as you can see here. Now, if you want to add a stop loss to this, you can see that this is our position. So it shows us on the chart. I don't have a stop loss, so I can add this after the fact. Add TPSL, take profit if you want a take profit price, and then a stop loss here, 50,000 like this. And the quantity, you know, we're going to sell our entire position if it hits 50,000, press confirm, and that stop loss is in. You can actually just see it here. So entry, stop loss, it's all in there, and it's all going to trade for us. So exactly as we want it. And as you can see here, you can close, so you can close the order as well. So we're going to go ahead and do that. We are going to mark it. And we're going to sell the whole entire thing, press confirm. That order is now out. So neither of those positions are in. It cancels the buy order that you had, the position that you had. It also cancels out the stop loss as well, because obviously we don't want that, because if the stop loss remained, that's a short order. And if it gets down there, you could potentially take a short. So it cancels both of them out. So now you don't have any positions. You've cancelled the position that you had and any orders, take profit or stop loss around that order. Please trade responsibly with leverage. I don't recommend it for 99% of people, but like you've seen, there are some occasions where we can actually use leverage intelligently and take a little bit of risk whilst not absolutely, going crazy with it. If you want the 5% lifetime fee discount for the wallets that you connect via the link below, that is down in the description. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.